We followed value pricing really early on in our journey. Really, we felt that customers would be looking for outcomes more so than they'd be looking for just like how long did this take you or how much time did it take to execute on. And so, yeah, it's been since day one because we've always believed in that philosophy.
This is the Staying Power Podcast, a show that explores the challenges business owners face as they grow. I'm Brandon Hall.
And I'm Thomas Castelli.
And together, we ask the tough questions to show you that running a business is not for the faint of heart. But if you have staying power, you'll overcome your challenges and achieve lasting success.
Hi, everyone. Thanks for tuning into this episode of the Staying Power Podcast. We're joined here with Mike Pinkus, founder of ConnectCPA, a Canadian-based plug-and-play virtual accounting and bookkeeping firm that solves the finance pain point for scaling companies. Today, we discuss how Mike scaled ConnectCPA over the last 6 years, including his sales process, why value pricing works for his clients, and growing via word-of-mouth referrals. We also discuss the role technology plays in building a bookkeeping and accounting business, Mike's biggest challenges, and more. Before we dive right into today's episode, we did want to announce that the Staying Power Podcast will be officially moving from a weekly show to a monthly show in order to deliver only the highest quality content and interviews to our listeners. And with that being said, let's jump right into today's episode. Hey, Mike, thanks for taking the time to come on the show today. Would you be able to give our listeners a little information on your background?
Sure. Yeah. So I co-founded a company called ConnectCPA out of Toronto, Canada. My co-founder, Lior Zetzer, and I met at Price Waterhouse in the early 2000s. And really, we're a technology specialist chartered accounting firm, and we specialize in streamlining the operations and tech side of the finance function for high-growth technology companies. And we've been in operation since 2014.
Awesome. What was behind your decision to go out on your own and to start the CPA firm in the first place?
Yeah, what's interesting is I, in undergrad, didn't even come from an accounting background. I majored in finance, ironically, and I took that first job with PwC back in 2007, and it wasn't really for me at the time. Like I wouldn't say I was your traditional accountant, and I ended up leaving to work in private equity for a little while. And then I ended up going back to a small firm because I thought I wanted to own something. I wanted to have autonomy to be out on my own. And then I went for a beer one day with Lior, and we had a discussion about how in New Zealand and Australia, they were leveraging technology and doing some interesting things. And we had a discussion about how we wanted to bring that to North America. And so that was really the genesis of ConnectCPA.
All great ideas start with a beer, right?
It's always starting with a beer. Gets the juices flowing, right?
Oh, 100%. So where are you at today?
Today, so our team is around 40 people, and we're Canada-wide. So we're a completely virtual distributed team. And really, it's been an interesting ride. Like just the headcount change has been fast and furious from our perspective. And it's been something that's been pretty challenging. But like in 2019, we closed out the year with 25 people. So in the first 10, 11 months of this year, we've grown by about over 70% headcount. And it's been a wild ride kind of managing just the growth and catering to the market that we serve.
How much have you grown from in terms of employees? How many employees do you have, at this point?
40 on the team. Yeah. Or I think it's about 40. Yeah. Like give or take one or two, it might be 41. I'm not exactly sure because we've been hiring in the last few weeks, but that's pretty much where we're at.
And has this growth, has the growth of your firm just happened organically, or have you had to make major pushes in order to scale to this point so far?
Actually, we've believe it or not, scaled organically. There's been no marketing whatsoever over from 2014 up until today. We were a bootstrap business that just delivered really high level, high caliber service to customers. And it's caused a referral engine. And that's been where almost all of our growth has come from. So referrals, we have an online presence. So we're on LinkedIn and Twitter and Instagram and Facebook. And so we're in the normal social media realm as well. But that being said, most of our growth has been generated through referral or just online presence.
Gotcha. And if you don't mind, what's the size of your revenues today?
That's so I can't tell you exactly, but we're actually in the fastest growing company list in Canada. It was released by Globe Mail a few weeks ago. and they put us in the bandwidth, and I'll tell you what the bandwidth was, 2 to 5 million. We're somewhere in that bandwidth.
Nice.
Now you said you are growing based on referrals primarily. You haven't done any marketing, which is incredible. And you've done that by providing high caliber services. Can you kind of explain what that means?
Yeah, sure. So I think what's very important first is to go over what a typical relationship is like with a traditional accountant or an accountant over the last, call it 50 years. So a big part of the problem we were trying to solve as an organization was that a typical relationship with an accounting firm, not that this was an issue, but normally what would happen is you'd meet with your accountant once a year. It was more of a compliance relationship where you'd go and complete a T2 corporate tax return, a set of financial statements, and maybe you'd call your accountant once a year if you had any questions. In terms of service level, we just bring things to another level, which is we feel like customers need greater intimacy in the relationship with their accounting / finance function. And so we've become an extension of their team. So some of those things in service level that have changed or that we do that go above and beyond what you'd expect from a traditional accounting relationship are we respond to customers within 24 hours of queries coming with a guarantee. We will produce financial statements within 1 to 2 months of year end. We provide monthly deliverables of bookkeeping engagements where they get their profit and loss, balance sheet, and cash flow within about 10 to 14 days after month end. And so some of these timelines are just unheard of under a traditional landscape, and it's raised the level of service that I believe businesses today are now accustomed to, because most tech companies today, everything's instantaneous. You're on Zoom, Slack. You can get a hold of someone very, very quickly. And that immediate gratification of being able to just get what you want whenever you want it, we're trying to cater to that as much as possible.
That's interesting because we've tried to do that too, and definitely some pros and cons that come with it. So tell us where you've struggled with trying to cater to this instant gratification. I'm assuming in terms of communications with clients.
I'd say some of the challenges is we have unlimited support agreements, and so what that means is someone can ask a question whenever they want, and there's no adversarial relationship associated with trying to get a hold of us, meaning you're not going to just be billed at a high hourly rate. With that comes challenges. There's a lack of barriers, right? And so I'd say the number one challenge is, what does customer success look like for an organization that does not have barriers, meaning unlimited support engagements? And that's something we've been trying to solve for the better part of 6-7 years.
Yeah, I think it's something that we've seen as well. We've tried some of these more unlimited open style engagements, and from our experience, it's been kind of rough because it's just, you can easily be finding yourself going down rabbit holes that are taking a long time and you're not being paid for it because it is such an unlimited style engagement. So at this point, I don't know if that there is a good answer to that, but that kind of brings me into a good question. We notice you do value price. You don't do hourly billing. Did you ever experiment with hourly billing or other pricing options, or did you just kind of dive right into the value pricing right off the bat?
It was really from the onset. We were value priced. We followed value pricing really early on in our journey. Now, that's not to say that we wouldn't have an hourly engagement from time to time when there was something that was impossible to scope out. And that does happen from time to time where we'll have an hourly rate associated with a certain project that's impossible to know how big or expansive that project might be. But we dove into value pricing really, really early on. And I know this is going to sound simple, but I like to make an analogy. Obviously, a service is different than a product in the sense that there's a finite amount of time, and then you really have to garner that time as a professional, and your time is valuable. And so there's a reason why traditional firms have always attached a high hourly rate associated with their time. That being said, we used to always look at the analogy of like a vehicle. If you went into a Honda dealership and they showed you 2 Honda Civics, a blue and a red one, and they said to you, one of them is $20,000, the other one's $15,000. And the reason why that one is $15,000 is it took less time to manufacture it. You ultimately wouldn't care. And obviously it's not a perfect analogy because with services, it's more complex than that. But the general premise of that still holds true, meaning everyone is looking for an outcome, meaning they want financial visibility. They want things as fast as possible. and they want clarity over decision making. And like that's ultimately why you want a financial advisor, is to make better decisions as a business owner. And so with that comes a lot of things like real-time information, making sure you're compliant with your tax authorities and all the other things that you need to do as an organization. And so really we felt that customers would be looking for outcomes more so than they'd be looking for just like how long did this take you or how much time did it take to execute on. And so yeah, it's been since day one because we've always believed in that philosophy.
I think it's kind of interesting because we've floated back and forth between value pricing and hourly rates. I mean, we value price some parts of our engagements or some portions of our services, and then we hourly price other portions of our services. And because we agree with you in general that people in general are going to be looking for outcomes, and you want to price that outcome. But it's also, at least in our work, in our field, you can get super complex issues and very infrequent issues. And I kind of akin it to my relationship with the law firm that services our firm, which is why we feel okay hourly pricing. But I wouldn't want a fixed engagement or a value priced engagement with them. I would just, like with them, it's great because I have a question or an issue once every like 6 months. I can call them up and just say, hey, what's the answer to this? Okay, yeah, it's going to take you whatever time to put an operating agreement together, and I'm good with that. So it's kind of interesting because we've had this conversation internally multiple times. Like, should we just move everything to value pricing, everything to fixed pricing? But I don't know. I don't know. I mean, I think that definitely has its merits, but I think hourly pricing also has its merits depending on how you're using it, right? And I think that, to your point, most CPAs or most firms just use hourly pricing for literally everything. And I don't know that that's the right answer. But in my case, where I've got one question every 6 months for my attorney, I'm cool with being billed hourly for something like that. I don't know. It's kind of a weird middle ground, you know?
I would agree with that. Look, I feel to have a value price, there has to be a cadence to things.
Yeah.
So if you're going to have, if it's for just, I call it consulting, meaning you have an agreement every 3 months, or you're going to reach out to your lawyer 2 to 3 times a year, that's not going to be well suited to a value price because there has to be a cadence to a deliverable. And when you think about deliverables, like especially call it like a bookkeeping engagement, something that has an ongoing day-to-day recurring theme to it, where you have to be in the books every single day to keep up with the reconciliations. You have a deliverable every single month. And so those types of engagements lend themselves to value pricing really well. Whereas, as you alluded to, Brandon, if you have like a one-off question 2 times a year, I would say that an hourly rate is more, it's more suitable to that type of engagement. But the one thing I would also mention is you can't fully capture value always in an hourly rate. And what I mean by that is an hourly rate is you're selling your time. What if something is worth far more than your time? And that's where those are the interesting questions that I believe that services firms or companies that deliver high value to customers should ask themselves. Meaning, what if there's something that you're allowing someone to make a decision that saves them $50,000? What is that worth to the customer? Is that worth 2 hours of your time, or is it worth $10,000 for them to save 50? And so the question becomes, what is the value that you're providing them? And I feel like that's where things get muffled with an hourly rate. So I completely agree that for things that don't have a cadence to them, there's no way around it, unfortunately, or complex engagements where you can't scope out what the inputs are in order to figure out price. So there's definitely a place for hourly pricing, but for things that have a general cadence to them, value pricing works really, really well.
So with the value pricing, how do you determine upfront what that value is without sinking a tremendous amount of time into that like initial exploration to find out what that price should be? Or is
it
that
is
how
done
it's
that way? So we have a discovery call where we learn everything about an operation of a business before we ever move on to providing a price. So we also have a technology meeting where we educate a potential customer on just what are the services that we offer. Really, our goal is to help companies scale. And in order to help them scale, we have to understand what their setup and design is in place right now over the finance and accounting function. Where are they at operationally? Can we remove redundancies, create automations, and improve financial visibility within the company? And then finally, how do we bring them to the next level based on their goals? So we ask those deep dive type of questions. Like, if you're at 1 million ARR, where do you want to be in a year? Do you want to be at 2 million, 3 million, 5 million? If you want to be at 5 million, Well, that means you're going to expand very quickly. Your team's going to grow. So now we have to be armed in order to deal with that growth. And so only certain types of high growth service providers can even support the growth of these technology companies, because they might raise a venture capital round and go and hire 100 people within a 3-month period. That's a huge undertaking if you're running their payroll, their bookkeeping, their payables and back office. And so you have to ask those deep dive questions to really gain an understanding in order to take on a value price engagement. So the quick answer is there is no click here buy. There's a discovery call, a technology meeting, and then finally a pricing call in order to scope this out.
Got it. That's what I would imagine would have to be done to go into the value pricing. There's a lot of the work has to be done up front. Does that slow? I mean, it has to slow down the process to bring on clients, but does that slow down your growth overall? Or I guess if you get a lot of inquiries coming to you asking for services, how material is that in growing your firm? How much is that?
So it really depends on who your target audience is and how you define growth. We typically will cater to fast growing businesses. And so normally we would set like a minimum benchmark that a company is at least call it 300,000-ish in revenue or more. But our typical customers between 1 to 5 million ARR, some are well above that, some are below that. And in order to help, really, we're looking for businesses that we can add value to, which means that they have to have the ambition to grow. And if they have the ambition to grow, we want to help them on that scaling journey. And so does it slow things down? Sure, a little bit. But at the same time, we are forming, I think, greater relationships where we really become an extension of their team over the finance and accounting function. And because of that, it also enhances referrals and the speed of referrals. And so what I would say from a growth perspective is the sales cycle, believe it or not, is shorter than you would imagine, normally because there is urgency. There's not many, I'd say, tech-enabled service providers that can actually handle the growth of a fast-growing venture-backed tech company. And because of that, there's not a lot of options in the marketplace in order to help out these companies as they're growing. So there's urgency. And what I mean by urgency is it's normally the customer that is forcing us to move quickly, not the other way around. And that's normally because they have deadlines to hit. They have boards, advisory committees. They have KPIs that they need insights on. All these things need to happen quickly because their business is moving quickly. And so I think the slowness of the discovery process is offset by the urgency of the need of the customer to get the information they need to grow.
That makes sense. And in your particular firm, do you do the sales? Do you do the sales with somebody else, or do you have like a dedicated sales person to handle those sales?
That is an excellent question. So it's myself, my business partner, Lior, have been handling sales since day one, but that's come up in conversation more times than you can imagine of talking about, should we have a sales team? And truthfully, I believe that any repeatable business, in order to scale effectively, eventually does need a sales team. And so it is something that comes up quite often. The issue with the sales role is someone with a sales background wouldn't necessarily excel in the role of sales at ConnectCPA, only because they would have to have a dynamic background of probably being an accountant, because a lot of accounting issues do come up in these discovery calls. They'd also have to be trained over the technology piece, which is, and by the way, that's not my role within the organization. My business partner, Lear, is the one who heads up the tech side of the company. But I know enough to be dangerous, meaning like you have to be able to fully understand like the blueprint or the 30,000 feet view of hearing the issues and problems the company is facing. You have to have more than a glossary view of what a setup and design and infrastructure would look like. And so I guess our fear in bringing on salespeople over the years has been, how do you train someone for this role? And it remains a fear. It's why we haven't done it yet.
In our experience, we've had a few salespeople, and it is challenging. It is challenging to get them to understand such a technical, accounting and tax is such a technical.
Do you still have those people? I'm just curious whether the experiment worked. Meaning, like, did you revert back your sales process to the ownership of the company, or did you guys stick with the sales team?
So we ended up sticking with the sales team. I think that's critical for continued growth, to have some sort of like business developer, somebody that fields a lot of the intake. One of our problems is that we get about 60 inquiries a week. So I can't handle everything. Tom can't handle everything. We've got to focus on other parts of the business. And so our prior sales folks, we did revert from what latitude we were giving them. So they were able to go and, scope and price everything and sign people up. And we realized that you really have to have a good understanding of tax and accounting to really unearth all the problems that prospects have in 30 minutes. It's like, it's a relatively quick time to kind of get a feel for what somebody needs and how we can help them. And if you don't have the technical expertise, the technical background, it's going to be really difficult to do. So our current sales process is we do have a salesperson, but their job is more of like a kind of a gatekeeper. So their job is to try to figure out what are your core challenges and is it big enough to put on the phone with Brandon or Tom to then have a conversation about services, scoping, and pricing. So we kind of reverted from giving salespeople the full latitude to go ahead and make the sales themselves to more of a process that standardizes it a little bit more clearly and allows somebody on our team to get on the phone with a client and understand what their core needs are. That said, our current salesperson is really great and is picking up a lot of the technical stuff as they go, even though they don't have a tax and accounting background. So we're thinking about kind of retesting out this, giving him more latitude, but we've got a very specific set of services that we're going to give him that latitude on. So we're going to see. We're going to see.
No, it's cool. And do you guys get it? I'm sorry to be asking some questions here, but I'm actually curious. Do those 60 leads come in organically or through marketing or SEO? Like what generates those leads?
We're huge on content. We have a podcast, the Real Estate CPA podcast, and it has about 40,000 listens, downloads a month. So that's a big one. We put out like pillar pages, like guides that rank top of Google, that explain concepts in depth. And then we've been guests on tons of different podcasts, webinars, speaking events, that type of thing. So it's really just the content, and people just find us from all the content and they come in that way.
For you guys,
we haven't really
awesome.
run ads or anything. So it's just kind of everything that we know, we just give away for free. We'll give all the citations. Here's how you do it, top to bottom. And people start reading it and they go, no, thanks. I'd rather just call you guys up and have you do it for me. But glad that you guys did this so that I know that you're experts.
Very cool. Yeah, we have similar, like to your point, we have higher lead flow than we can obviously entertain every call. And it's very difficult to, like, we have our parameters of what would be like a minimum reservation type of set of circumstances in order to engage with a customer. And so we don't reply to every single one of the leads that come in. And not only that, it's why we can't automate it either, because we could have set up obviously a reply bot that would issue an account link. You can automate it if you wanted to, but that would be overwhelming. You'd get things that don't make sense. Your team would hate you. And so we don't do that either. And so yeah, it's a challenge. But to close on this point, I completely agree that at scale, I believe a sales team is a necessity. It's just something we have not done up until now.
Well, I want to talk about that whole automation thing a little bit too, because it seems like we have very similar issues with us. So we niche in real estate. We work with a lot of landlords, real estate investors across the United States. Mm-hmm. And our problem is that, the 60 leads coming in, maybe 30 of them every single week are clients that will pay us several thousands of dollars to go through an advisory engagement, learn about tax and what they can do to implement a better tax strategy and optimize the situation, yada, yada, yada. But it literally pains me. The other 30 people that wouldn't otherwise qualify, it literally pains me that we can't help them, because we looked across the United States and there's so many bad CPAs out there. And not like bad CPAs, just real estate tax is super niche. And I'm sure that you experience this too. When you get like niched into something, you start seeing all the small things that over time add up. It's like the opposite of death by 1,000 cuts. It's like the little things that ultimately make you like a huge winner or a huge loser at the end of the day. And we see just so many bad tax returns, but we can't help them because it's just so expensive to make it economical for ourselves to work with people one-on-one. So what we did is we actually read Russell Brunson's books. He's got 3 books. What is it?
It's .com secrets, expert secrets, traffic secrets. It's a trilogy.
Yeah. Highly recommend that you check him out, Mike, because this
Russell Brunson, you said?
Yeah, Russell Brunson. Yeah, the ClickFunnels founder. So if you've got too many leads that you know what to do with, the problem is that you could probably help all these people if you had a better defined value ladder. And what I've realized in reading these books is that most CPA firms have the middle of the value ladder defined. It's the tax services, the accounting services, the whatever, but they don't have anything down the value ladder. And so our problem has always been, which of the 60 people, number one, will pay our fees, number two, we could help, and number three, are ready to go today. And that's the wrong way to think about what a qualified buyer is. A qualified buyer is somebody that's gone up your value ladder. So you start off with a book that's $10. They buy the book. Well, they're qualified. They're a qualified buyer now, technically, because they spent money. So they buy the book. You pre-frame everything in the book. You provided them with a lot of value for their $10, but you pre-frame the rest of the value ladder. The next stage might be a course. The next stage is the actual consulting with you. And I mean, you could have like all these different stages. But the point is that, and we're just now implementing this now, so I'm sure that I'm not doing it enough justice for anybody that's listening and that's familiar with this. But what we're doing right now is we're saying, hey, those other 30 people that are coming in that we can't help on a one-to-one basis, we can help in a group coaching environment. And we've created that. And then the next rung down is going to be a book and like one-off, like week-long boot camps or something about real estate professional status, which is a real estate specific tax issue. But for us, it's nice because we get to help a lot more people. We keep them in our network and we get paid for doing it at the same time. And we get to pre-frame all of our other services. Like in the real estate space, nobody cares about bookkeeping. No real estate client cares about bookkeeping, but as part of the course, you get to explain how important bookkeeping is on a relatively automated basis. So then they go, I want bookkeeping, and you can start selling those services next. So you're just stepping them up the value ladder, but at every stage, you're just providing that much more value to them, and they just want to keep going up the value ladder. And that's how people, I don't know if you've ever heard of these people that like pay for $40,000 masterminds. Well, they don't like, it's not like if I walk up to you on the street and I go, hey, Mike, I can grow your business to $1 million or buy $1 million over the next 18 months, pay me $40,000 to do it. You're going to be like, yeah, go pound sand. But if you buy my book, if you go through my course, if you go through the group coaching, if I ascend you through my value ladder, at some point, I'm going to say, hey, Mike, pay me $40,000 and I can add $1 million of revenue to your business. And you'll be like, I believe you. Let's do it. It's just kind of reframing that entire, just where your services stack up. But if you look across, if you read those books, read the books, because it'll be a complete eye opener. But you read the books, you start looking across all the CPA firms that are out there, in really any business. And you just start realizing like, wow, everybody's got the middle of the value ladder really well defined, but they're missing so much by not having the lower end or even the top high end of the value ladder defined. And it's fascinating. It's really fascinating.
It's interesting because I am a believer you can't be everything to everybody. And I say that because, again, I'll use the automobile analogy. Like, you can open up an auto dealership and sell a Tesla 60,000 Canadian, 35, 40,000 US, whatever the price point is. And at Tesla, you're not gonna wake up each day and go, yeah, someone who's got $3,000 in their pocket's never going to be able to afford my Tesla, but I'm going to garner the relationship. I'm going to teach them about the automobile. Like, the reality is, like, you can't be everything to everybody. And while in certain businesses, I totally agree that you should, in certain types of industries, it makes a lot of sense to cultivate relationships all the way from low, mid to high. If it depends on, I believe, what you're doing. Like for us, we become the finance accounting department. We're like a plug and play accounting department for a fast scaling technology company. But in order for a business to have a need for us, they have to have a need for an accounting department, meaning that they have to be at a certain revenue size. And yes, we can start garnering those relationships really early on. But to your point, you would have to, given you have in-depth tax experts and high salaries and big overhead in order to run a technology specialist firm, you can't have your people spending time cultivating those relationships. You'd have to do it in other ways, like you alluded to, whether it be a book, a course, a group session. So there probably are ways to do it. You just have to be cognizant that it's not one-on-one type.
100%.
Yeah.
But here's the thing though, Mike, when people call you up, they know that they need the accounting department. right? They're already at that point. But what about all the other people out there that you know that they need you, but they don't know that they need you? That's
for sure. Yes.
The lower end of that value ladder. So it's just like, okay, like for us, for example, we've got this whole slew of tax strategy available. And there are people out there with 100 unit portfolios that we know need us. They don't know that we need us though. So how do we get in front of them? Perhaps it's a short book that somehow gets across their desk, and it's just about real estate professional status and how you've been doing it wrong. And it's just very short, right? And then they go, "Oh, I'm a real estate professional, and I'm going to pick up this book." And we go and show, here's how your CPA has probably been doing it incorrectly in the past. And they go, "Wait a second, I need to get more information on this." Now they're starting to think, okay, wait, I might need a different level. So I mean, point is that you can define those stages of the value ladder, and you can automate a lot of it. I mean, the course that we've set up is it was 5 weeks. I did a pilot course, and that was a lot. It was a lot because I was doing it live. But now I've got a bunch of pre-recorded sessions that I'm just going to relaunch, and we're just going to keep relaunching, because we know that even though we can't work with all these people one-on-one, it's just not economical for us, and it's not really the type of client that we're looking for. We still know that they need our help. And we know that in 3 to 5 years, as they continue growing their real estate portfolio, then they could otherwise be great clients for us. So it just kind of starts the relationship early. Maybe like the lower part of the value ladder for you is not necessarily new technology companies. Maybe it's a technology company that realizes there's something, maybe their current accountants don't reply to them fast. Maybe it's just like little issues like that they're thinking about what else is out there. And you've got this way to kind of funnel them up and through your value ladder to ultimately get to your services. But it's nice in this model, at least this is how it's supposed to work. We're at the very beginning stages of this, but it's nice in this model because they buy the book, they ascend your value ladder. By the time they get to your one-on-one services, you talk about value pricing. It's just, here's the price, and they're hooked. There's no explanation of value at that point because they've been pre-framed for however many months. But anyway, yeah, it's a really cool set of books. Tom made me read it. So maybe Tom.
I've marked it down. I'm gonna take a look because I'm an avid book reader when it comes to business books.
So am I. Likewise, I have to say that this book, once you read it, you'll see this everywhere. You'll see how so many businesses do this. You'll see how businesses in the past that you probably worked with or wanted to work with have been doing this all along. And it's just like, if I had to pick like one set of business books, this would definitely be at the top of the list. This trilogy is something that any business owner should read because it's literally it's an eye opener, and you will find ways that you could apply it to your business, no matter what type of business you have. After reading the books, it's all going to click. It clicks for everybody who reads the books.
That's really cool. Yeah, we read a book that was like that for us. I guess EOS, the Entrepreneurial Operating System. I forget the author's name. Doesn't come to
Gino Wickman?
Yeah, Gino Wickman. Yeah. That's it. Yeah, that was an awesome book. That one was one of those game-changing books about running an organization. But yeah, there's always a few that stand out and catch your attention for sure.
Yeah.
Yeah. Switching gears a little bit, it's going to be totally a different question from what we've been talking about. But I know before you were mentioning, and throughout this conversation, you're a technology-based firm, tech first kind of type of thing. Mm-hmm. How big of a role does tech play in your bookkeeping services?
Huge role. So we actually have a team of people that handle technology onboarding and data. And that plays into everything that we do. When we onboard a new relationship, we customize the bookkeeping and the infrastructure based on processes that we've used over and over and over again, but also our tech team is constantly innovating, meaning we're learning about new tech that's in the marketplace, meaning new add-ons, applications that we can integrate in on a software basis. And then we make it bespoke. I mean, we look at the client situation and we have to figure out how to customize something that's going to improve their financial visibility within their organization. So every company is unique. And so we customize that plan for them. And that happens right from the onset, including the bookkeeping processes, because you're only as good as how accurate your data is. And so it all bleeds into the bookkeeping process. And by the way, I mentioned technology companies we deal with, but really we deal with e-commerce, SaaS, inventory businesses, and we even deal with service businesses, but we have very specific processes over those verticals.
So Mike, we like to ask this question to everybody that comes on the podcast. Was there a particular challenge that you've faced as you've scaled your business out and you've experienced considerable success since you've launched? Was there a particular challenge that you faced that was so treacherous, so overwhelming that you almost said, you know what, I don't know if this is for me? Almost threw in the towel, went back, got a W-2 job. Did you ever face something like that?
I wouldn't say quite to that level, but I've had my moments for sure. I'd say the hardest thing where you have those days where you're like, you want to throw in the towel. Those happen when you're scaling a company and you start to define your leadership team. And the leadership team is really a group of people that autonomously make decisions in the absence of like the founders or the co-founders. Like they're no longer in the picture, and the leadership team comes in and they have the authority, the autonomy to go in and make decisions. And once you're at that level, I think in any scaling journey, you are going to run into situations, no fault of the team, but fires start to erupt. And sometimes the only people that can put out a fire are the founders. And what that does is it just takes up your time. It takes up so much time that you have to make an extra phone call. You've got to jump in and email someone back right away. You were in the middle of a meeting and all of a sudden you get a Slack message and you've got to run away from whatever you were working on to handle it. And you start to realize that no matter how far you scale and how big the team size gets, there's always going to be situations that are going to require you as a founder in a business to get involved, even when you have a high caliber, really polished, well-versed leadership team. And so again, it's not the leadership team's fault, but I've had a few situations where, and I think this has gotten better over time because now the team is getting more trained up. They're being exposed to more situations and fires, and they're becoming more comfortable at being able to help customers when a problem arises. But I would say when we reached the inflection point where the team wasn't quite expanded out in that leadership bracket yet, and there wasn't quite the training yet on how to deal with those situations, it got to a point where we were just in every meeting, every situation. So that's sales, like CS, customer success, management of your team, making sure that people are doing what they're supposed to be doing and adhering to core values of the company on a day-to-day basis, all those things. So there's been some breaking points, but luckily we've always kind of pushed through those inflection points and moved on. But yeah, you're definitely pushed on stress. I don't think there's any founder that can confidently say they haven't gone through those moments.
Yeah, I can attest to that. Now, you said you've pushed through the inflection points. How do you push through those inflection points? How do you train up your leadership team so that they can take more of that type of stuff on? Because I've found that as a founder as well, you really need to figure out, I mean, the highest best use of your time is not going to be handling those client issues in most cases, unless it's a massive client. But it needs to be done regardless. And I agree. That's what pulls my energy down, right? Whenever I have to deal with something like that. So how do you train your leadership team up so that they can handle that type of stuff? How do you push through those inflection points and get it to the point where other people in the firm can step up to the plate?
One is letting go. Sometimes you just have to let go and realize that like you want things done your way, and that's just not reality. Like you can't scale if you're not willing to let go. So one is letting go. Two would definitely be trust in your team, which is that's a little bit different than letting go. What I mean by trust is like, it's one thing to let someone go and make a decision. It's another thing to trust the decision they're going to make, no matter what that decision is, whether you would have agreed with it or not. And until you get to that place where you're going to put trust and confidence in the people that you bring onto your leadership team, if you're not willing to do that, you do have to ask yourself, do you have the right leadership team? And that's also a difficult thing to think about. And so I feel like at least at ConnectCPA, we have talented people, and sometimes it's just forming expectations with people, meaning like we constantly go back to our mission and our core values. Like that's what keeps happening. And you see that the leadership team has developed and gotten stronger and stronger by keep going back to those values and that mission over and over and over again, like a broken record, until people start living their life based on those things. And that's what allows you to really like break through, I think.
So that's super interesting. How do you keep going back to the mission and the core values? What do you mean when you say that?
I mean, you have to have operating principles that are not granular, that people operate by and live by, meaning you hire, fire, and promote based off of those values. The other thing that's important, I think, is you can't have a laundry list of values. We used to have like 10, 11 core values. And then if you put me into a meeting and said, hey, Mike, list off your 10 core values, I'd be like, I can give you 5 of them right now, and then I'll open a PDF on my other monitor, and then I'll get you the rest of them. Because it's like, people can't like think about 11 things in the middle of their day that they should abide by. For us, we narrow it down to 4 things. And then that's really it. We have a mission, which is helping companies scale their businesses. And then we have 4 core values. And what those core values are going above and beyond, taking ownership of your work, being transparent, and putting the team first. Those are the 4 things. And if they live by those 4 things, then everyone's happy.
What happens when they don't live by those 4 things?
That's why you have quarterly meetings. Or as they say in EOS, you have your rocks, your quarterly discussions where every quarter you sit down. That's why transparency is one of our core values. And again, I keep saying the leadership team, the higher up someone is within an organization, the more you should be able to be open, honest, and transparent with them. Meaning like it's an okay thing for them to tell you, hey, I don't feel like the company's being run properly. And for you to tell them to say, hey, listen, like, I don't feel like you tackled this situation correctly. But if there isn't that open, that radical transparency of just like laying it on the line, and it's out of love, it's like there's a good relationship between everybody. There should be conflict within an organization in order to get to the right end goal. But if there isn't that open communication where you feel completely comfortable to not sugarcoat something, that's where things really fall apart, because you don't say what you mean. The team doesn't say what they mean, and then everyone just harbors their feelings inside. And there's like this hostility that's under the surface that nobody even knows about. So I feel like it's so important to be transparent as a company.
Yeah, definitely. In my leadership team, we've been going through some group coaching. We've hired outside consultants to come in and just help us learn how to work better as a leadership team. And it's been phenomenal. It's like therapy. I highly recommend that anybody that you go and do it. But that's one of the things they said too, because we value transparency. And I don't even remember what we were talking about recently, but they said something along the lines of, hey, if you don't get out there and get ahead of the narrative, then the story is just going to grow naturally by itself. People are going to talk about it among themselves. So you might as well get ahead of whatever it is and just be open and transparent and just say, this is what's going on. This is why we're doing it this way. Then there's just nothing to talk about. But if you leave that open to a guest, then you've just fueled the fire of people wanting to try to guess what's going on. And that's where all the gossip starts. The negativity can come from. So yeah, definitely be transparent, be open, be honest, especially the higher up that you get to. I think it's really important to maintain that transparency.
No, for sure. I agree.
I have to agree as well. So we're kind of coming up against the clock here. If our listeners, it's been a great podcast so far. I know I learned a lot. If our listeners want to learn more about you, what you have going on, and a little bit more about your business, what's the best way for them to do so?
Yeah, I'd say the number one thing is I'd always direct someone to our webpage or landing page, which is connectcpa.ca. But you could also find us at ConnectCPA on LinkedIn. You can find us ConnectCPA on Instagram and Connect_CPA on Twitter. So a long story on why we didn't get ConnectCPA on Twitter, but I'm not going to get into that today.
I hear this is a fight for domain names these days.
It's so funny.
And user tags. Yeah.
Yeah.
So we'll go ahead and drop that in the show notes below for everybody who's listening who does want to learn more about Mike's business, ConnectCPA. And Mike, want to thank you again for coming to the show today. Fantastic episode.
Thanks a lot, Thomas. Thanks, Brandon. Appreciate you guys having me.
Thanks for listening. If you enjoyed the show, leave us a review on iTunes and share the show with other business owners who may be facing their own growth challenges. And if you own a professional services firm, consider joining our private community. The Staying Power Collective is a community where owners of accounting, law, and consulting firms discuss best practices for running and growing virtual businesses. You'll get access to our Slack group, and you'll have a Zoom meeting once a month with a small group of other firm owners. To apply for the group, head on over to www.stayingpowercollective.com and fill out the brief form. And if you have suggestions for future topics or guests, or if you have general questions or feedback, send us an email at contact@stayingpowercollective.com. Thanks so much for listening, and have a great rest of your week.